Over and over again, I see ICT traders make the same exact mistakes. You are using too many things. You need to simplify your trading. And in this video today, I'm going to show you exactly how I would go from 0 to 10k a month from trading if I had to start all over again. Like I say, you're probably using too many things and it's causing you to stay stuck in the same point. I only use 20% of what he has taught and I've refined it into one candle. So as usual, let's not waste any time. Here's exactly how I would go from 0 to 10k a month if I had to start again in the shortest amount of time possible. Now, the very first thing, you might be thinking it's a model, right? No, the very first thing is mentality, not psychology. Now, I've got max allocation. I've had that for almost a year now. The truth that no one has told you about trading is that you actually need less, especially ICT traders. You use way too many things. You need 20% of ICT and can completely ignore the rest. Now, what do I mean by mentality, not psychology? Well, let's put it this way, and this relates directly to your trading. It's very important. If you flip a coin, it has a 50-50 chance of landing on heads or tails. Most people expect the odds from a coin flip to have linear distribution, meaning, for example, heads, tails, heads, tails, heads, heads, tails, tails, back to back. But this almost never happens, as this is not how numbers and averages behave. We need to relate this to trading as well. It is just as likely we get heads, 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 tails, 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 tails. Understand that. That directly correlates to trading probabilities. That's why I've put the same is true with trading. Odds do not create equal distribution in small data sets. So how do we use this information? You need to stop quitting your model after a few losses. You have to stop changing your risk, your model, or your strategy after a couple of losses. The wins are around the corner, but you expect the distribution of your win rate to be linear. It is not linear. Stop treating it as such. I tell my one-to-one students all of the time, you guys have to have enough data, enough trades to realize whether your model actually works or not. That is exactly how we use this, okay? But this alone will not turn you profitable. A model will. This paired with a model will. So what do we do? Well, I've been saying it for ages, guys. We focus and we predict the very next candle. Nothing else. And I'm going to dive into trading with you to show you exactly how. But this is exactly why one candle theory exists. It's because we only have to predict the very next candle's expansion. If you are predicting that, then you have a trade within that candle. Now, how exactly would I get to 10k a month in the quickest time possible? Because this is a guide. First of all, I would use prop firms. Stop using your personal capital. It's just not worth it. If you have not got $100,000 put away, it is not worth it. So go with prop firms. First of all, the very first thing and the only thing I would do is take a 50k futures challenge. Now, I'm not endorsing any prop firms because they don't pay me enough for that. But a 50k futures challenge is what I would take. And when I say 1% risk, some of you are going to sit there and be, well, $200 is not 1% of 50k. You're right. But you get $2,000 drawdown. This is what everyone gets wrong about futures challenges. Futures challenges, first of all, there's a few things I want to go over. They are marketed as a one-step challenge. They are not a one-step challenge. It's 2 steps because you need to build a buffer anyway. It's just marketed so it looks good and looks like a one-step challenge. It's not. No one tells you this on YouTube because no one really thinks about it. All right? No one really wants the best for you, but this is a guide. It's a 2-step challenge because guess what? When you pass it, you still need to build in a buffer first. So it's 2 steps. Now, 1% risk is $200. Why? Because you get $2,000 max drawdown and you want to give yourself 10 losing trades. So $200 is perfect. You do not need to risk more than $200. You just simply do not. It's doing too much. You're going to blow the account and it's where everyone goes wrong. So we do 1% risk and then when you pass, all right, if you pass this account, right, and you get an actual funded account. So you pass and now you are funded, all right? We'll just put an F. So you are funded now. Build in the buffer. So it is still 1% risk because you need to build in the buffer on top of it. It's why I just said it's basically a 2-step challenge. No one will tell you this because they're either endorsing the prop firms themselves and it's bad marketing, or they just don't even really think about it. But it truly is a two-step challenge. So keep risking 1% until you get to 52,000. When you get to 52,000, you have two options. Either keep 1% risk or go to 1.5% risk. Okay? So when you pass and you build in the buffer, either go to 1.5% risk, or stay at 1% risk. Do not do anything other than that. All right? Now, if you end up getting to 55,000, which is where I'd really take a payout, to be honest. Anything above 52,000, you can start thinking about payouts now. I like 55 because I would take a $2,000 payout, still have good drawdown in because I've built in an extra 3K. So my drawdown's gone from 2,000 to 3,000 if I take 2,000 off of 55. So I'd keep trading it at 1.5% risk until I get to 55,000, and then 3,000 is the drawdown I get now. So you can either do that or you can carry on and then at this point double your risk to 2%, because now you can really run these accounts up. And if you get to 60k, you're laughing. You've got a massive payout. All right. This is basically what I do. This is exactly how I would go from $0 to $10,000 a month as quickly as possible. Now, this is the prop firm side of things. Let me dive on to TradingView and show you exactly how I'd go about trading itself and how I'd get from 0 to 10k in that quickest amount of time possible. By the way, I speak more about this in my free course. Top link in the description, 5 hours worth of content. Really, really valuable. All right, go over there and check it out. Anyway, back to TradingView. Guys, the simplest way I could put one candle theory is if you are predicting the next candle, you only need a stop run inside of that candle on a lower time frame and you have an entry. Truly, if you're predicting a bullish candle, you just need a stop run on the M15 and you have an entry. Now take a look at NASDAQ. I was calling this all week inside of my private Discord. If you're interested in that, it's links in the description. But I was calling longs on NASDAQ from here. What is the logic here? Well, first of all, we're trading at all-time highs. Naturally, in a bullish market, you want to keep longing until proven otherwise, right? And we were working inside of this candle's range. We hadn't taken the high or the low out yet. Now, there was a NVIDIA SMT on these lows. NVIDIA is leading the NASDAQ, so you can use it for SMT as well. That goes for any stock, whichever one is leading the NASDAQ at that time. By the way, this is private level stuff, so really note it down. There was an SMT on these lows, all right? The bodies of these candles are respecting the daily volume imbalance here. And again, we're in a bullish market. Now, that is the logic behind it. There's always a story behind price. Now, what was I seeing below here? First of all, this daily candle to me is predictably bullish. Why is that? Well, the logic I just outlined, and notice the body of this candle is not closing below our key level there. It is respecting the key level for this to trade higher. Now, what did I just tell you a few moments ago? What do we need to engage with that predictable candle? A stop run. What happens on the hourly chart? This is your daily volume imbalance, but take a closer look inside of this price action and you'll see a stop run. So what do we look for every time we have a predictable candle? Okay, and I'll note it down here. What do we look for when we have a predictable candle? All right, that's the big question. How do we engage with this? A stop run. That is it. You are probably looking for a more complicated answer, but guys, guess what? This isn't complicated. This is actual trading because your model needs to be simple. I told you I use 20% of ICT. It's true. I don't need anything more than this. A predictable next candle and a stop run inside or just before that candle. Now, whatever time frame, it doesn't matter. This could be an hourly or an M15. They're usually the ones I prefer. But you can actually drop time frame and then engage with this later on. So you can either take two entries. You can take an entry from below the stop run on a total soup entry or here. Why here? Because when we close above the down close candles that traded into the stop run, this becomes your bullish order block. And it's all logical. Guys, this happens so much when that next candle is predictable. So you have a bullish order block. The down close candles that traded into the low back here, get closed above, we retap, and that's another entry. So the only thing we look for when we have a predictable next candle is a stop run on the fractal time frame. Now, over here again, there is SMT on some of these lows down here. If you go to ES and YM, you can see YM ran lower below there. Now, that is a stop run to me, but if you drop time frame, there's a more valid stop run in here. All right. So again, we're predicting the next candle. So remember, guys, we're bullish on NASDAQ because we're moving away from that daily volume imbalance. So we're bullish on NASDAQ and we're still predicting the next candle. This candle closed up here. The next candle is still predictable. So automatically, I'm going into the day thinking, what? We have a predictable next candle. So what am I looking for? A stop run and or CISD. So am I looking for a stop run at a random time? No. Notice how this didn't run out this low. Why? Because this happened at an irrelevant time for the NASDAQ. So when do we look for it? At a key time, 8:30 a.m. If you're predicting a daily candles expansion, you want to look for a stop run inside of those kill zones. Those of you who have made it this far are giving away gems now. If you are looking for a weekly candles expansion, if you're predicting a weekly candle, you don't need the stop run to be in a kill zone. It can happen on the 4-hour chart outside of, it doesn't matter which 4-hour candle, okay? But if we're on these lower time frames, it needs to be in a kill zone. Look what we get. Stop run, rally higher. Did it take this low out? No. Why? Why didn't it take this low? Because this is where the displacement started. So this is your leg higher. Where the move originated from, this displacement move higher, you can look for a stop run inside of this price leg. But this low that started the displacement move higher should not be taken. And that is exactly how you engage with a predictable candle. After watching this video, you will never need anything again. That only applies if you actually go and use this model. Truly, I spoke about this loads in my free course. So if you want my free course, it is in the top link in the description. It's about 5 hours worth of actual valuable content that truly works and has made me over 6 figures, has me max allocation, and has me 7-figure funding with multiple firms. It's gotten my one-to-one students there as well. All of my one-to-one students are capable of doing this because I've given them the framework, and we hop on calls and we talk about that more. If you want to apply for one-to-one coaching, then I'm pretty sure it's the second link in the description. Now, with that being said, I hope you guys found this valuable as always, and this is the quickest way I'd go from 0 to 10k a month, just doing this. If you did, drop a like, drop a comment, subscribe if you are new, and I'll speak to you soon.